At December 31st, year 1, Eagle Corporation reported 1.75 million of appropriated retained earnings for the construction of a new office building, which was completed in year 2 at a total cost of 1.5 million. In year 2, Eagle appropriated 1.2 million of retained earnings for the construction of a new plant. Also, 2 million of cash was restricted for the retirement of bonds due in year 3. In its year 2 balance sheet, Eagle should report what amount of appropriated retained earning. Since the building is complete, this is finished, over. Now you have appropriated another 1.2 million for constructing a new plant. This is what you will report as a appropriated retained earning. The previous retention is gone, finished. So that makes A to be the correct option. Porter Company began its business last year and issued 10,000 shares of common stock at 3 per share. The par value of the stock is $1 per share. During January of the current year, Porter bought back 500 shares at $6 per share, which were reported by Porter as treasury stock. The treasury stock shares were reissued later in the current year at $10 per share. Porter used the cost method to account for its equity transaction. What amount should Porter report as additional paid-in capital related to its treasury stock transactions on its balance sheet for the current year? First of all, this is the par of the stock. This is the price at which the shares were bought. And remember, it's the cost method. That means when the shares are reissued again at a higher price, the additional $4 per share goes to additional paid-in capital or additional contributed capital. That makes B to be the correct option. MEG Incorporated December 31st unadjusted current assets and stockholders' equity sections are as follows. The investments and inventories are reported at their cost, which approximate market values. MEG stockholders' equity at December 31st should be. So we have been given cash, investments, and marketable securities, including 75,000 of our own stock. Clearly, this is a mistake. This 75,000 is your own stock, which must be reported as a negative element in your equity. So this is misreporting. So what are we required to do? Stockholders' equity. So this is it. This is your equity 556. Okay. From this, we need to deduct the 75 for treasury stock, and we need to deduct this negative figure for retained earning. In fact, it's a deficit. So if you simplify, what you get is 425. That's your answer, D. At December 31st, year 1 and year 2, Car Corporation had outstanding 4,000 shares of $100 par value, 6% cumulative preferred stock. That's the complete description for the first category. 4,000 shares of 100 par, 6% cumulative preferred stock, and 20,000 shares of $10 par common stock. At December 31st, year 1, dividends in arrears on preferred stock were 12,000. First of all, what is the amount of dividend they are entitled to? 4,000 times 100, that is $400,000 times 6%. That means every year this is what they are entitled to receive. Cash dividends declared in year 2 total 44,000. Of 44,000, what amounts were payable on each class of stock? First of all, out of this 44,000, you have to first pay this $12,000 in arrears. Next, you need to pay this $24,000 preferred stock dividend for the current period. That means this is what you need to pay out of this total amount. Whatever is the balance, that is 36 less 44, this is the amount attributable to the common stock. So that's 36 versus 8. That makes B to be the correct option. At December 31st, year 2 and year 3, Apex Company had 3,000 shares of 100 par, 5% cumulative preferred stock outstanding. No dividends were in arrears as of December 31st, year 1. Apex did not declare a dividend during year 2. During year 3, Apex paid a cash dividend of 10,000 on its preferred stock. Apex should report dividends in arrears in its year 3 financial statement as. First of all, you have 3,000 shares of 100, that means $300,000 times 5%, that means the annual dividend on preferred stock cumulative is 15,000. So for year 1 and 2, there should be a total of $30,000, of which you have paid 10. That means the balance to be reported as dividend in arrears is $20,000, and that makes D to be the correct option. You won't accrue this as a liability. You would report it as a disclosure in the financial statement. On March 1st, Raya Corporation issued 1,000 shares of its $20 par value common stock and 2,000 shares of its $20 par value convertible preferred stock for a total of 80,000. We need to allocate this amount between these two. The issue is we don't have been given the separate issue price of these two. So at this date, Raya common stock was selling for 36 per share and convertible preferred stock was selling for 27 per share. What amount of the proceeds should be allocated to Raya's convertible preferred stock? Let us do it for both. How do we allocate this amount between your preferred stock and common stock? Simple. First of all, the shares that you have sold, 1,000 common stock and 2,000 preferred stock. At this date, the common stock was selling for 36 and preferred stock was selling for 27. That means this is the amount, fair value of these shares, and this is. So since we have received 80,000 in total, so 80,000 times 36 over 36 plus 54, 90. Proportional amount that goes to common stock, and 80,000 times 54,000 by 90. That goes to preferred stock. That's what we are required to find out. So if you do the simplification, simple, what you get is C, 48. And for this, of course, would be the balance. During the current year, Onal Company purchased 10,000 shares of its own stock at 7 per share. The stock was originally issued at 6. The firm sold 5,000 of the treasury shares for 10 per share. The firm uses the cost method to account for treasury stock. What amount should Onal report in its income statement for this transaction? Listen to me very carefully. You don't report any gains and losses on treasury stock transactions. Never. Gains are recorded by increasing additional paid-in capital. Losses are recorded by first eliminating any balance in additional paid-in capital, then decreasing retained earnings. This is an important point. So you don't report any gain and losses on any treasury stock transactions. That's A. Each of the following transactions will cause a decrease in stockholders' equity except. Let us discuss these in the reverse order. A loss from a foreign currency translation adjustment reduces your OCI, which eventually reduces your equity. A loss on sale of discontinued segment, clearly it's a loss and that will reduce your equity. Declaration of dividend is paid out of equity, so your debit dividends payable credit your retained earnings, so it would also reduce equity. But a sale of treasury stock at less than cost, let me explain with the help of a journal entry, it will be reported, or in fact it will increase your equity. Let me give you an example. Assume that the treasury stock initially purchased for 1,000 is sold for cash of $600. Clearly there is a loss. So now the question is, how does it increases your equity? That's interesting. And related to this 1,000 stock purchase, 200 balance exists in additional paid-in capital previously. So what entry do you pass? You receive cash. So yes, you will debit cash. You need to remove this 200 from additional paid-in capital. You debit additional paid-in capital, right? And you credit the full amount of treasury stock at cost, right? So the balance, what you see here, goes to retained earnings. Now let us consider the items related to equity. Treasury stock credit, that's clearly an equity part addition, and these are the two items reduction from equity, negative, negative. So just look at this. Equity is increasing by 1,000 and reducing by 400. So net there is an overall 600 increase in equity. So let's go back to the question. So this is it. The sale of treasury stock at less than cost, it in fact has increased in stockholders' equity. So this is the one that will cause increase. The rest of these we have discussed, they will decrease the equity. Regency Incorporated originally issued 1 million shares of its $1 par value common stock at 32 per share. 1 year later, the company repurchased 200,000 shares at 40 per share, assuming that half of these repurchased shares are now reissued to investors at 45 per share. What accounts and amounts are credited to the journal entry to reflect the reissuance transaction under the cost method? Previously, the example I gave you involved loss. When the treasury stocks were issued, they were issued at a loss. This time they are being issued at a gain. So remember, any gain loss goes to additional contributed capital, or sometimes if the loss is more, goes to retained earning. It never enters income statement. Remember, out of this 200,000 shares, 100,000 shares are being reissued at 45 each, which means you receive 4.5 million cash. So you debit cash 4.5 million. Originally they were repurchased at 40 each. So 100,000 by 40, that means 4 million will be credited, of course, from the treasury stock under the cost method, and the balance clearly goes to additional paid-in capital or additional contributed capital, call whatever this said. Additional paid-in capital, fine. Additional paid-in capital. So that's the entry. So what you see, let's match the options. 4 million treasury stock credit, additional paid-in capital 500. That makes C to be the correct option. These two items. Sign Corporation issued 20,000 shares of 5 par common stock at $10 per share. On December 31st, year 1, Sign retained earnings were 300,000. In March, year 2, Sign reacquired 5,000 shares of common stock at 20 per share. Okay. In June, year 2, Sign sold 1,000 of these shares to corporate officers for 25 per share. Sign uses cost method to record treasury stock. This is the key point. Net income for the year ended December 31st, year 2 was 60. At December 31st, year 2, what amount should Sign report as retained earnings? The key point here to note is that the company is using the cost method to record treasury stock. So what we know, there has been a resale of treasury stock, and this resale was higher than the original issue price. So that means the price exceeded the acquisition price, so that doesn't go to retained earning, that goes to additional paid-in capital. So since none of the transactions affected retained earning, so retained earning would only consist of the opening balance plus net income for the period, that is 300 plus 60, that is 360. A is the answer. Murphy Company had 200,000 shares outstanding of 10 par common stock on March 30th of the current year. Murphy required 30,000 of these shares at a cost of 15 per share, more than the issue price. In fact, more than the par, and recorded the transaction using the cost method on April 15th. So what entry they would have made? So you would debit the treasury stock, credit the amount you paid. So debit treasury stock, credit cash. Then it says Murphy reissued 30,000 shares at 20 per share, more than the price you paid, and recognized 50,000 gain on its income statement on May 20th. This is very wrong. You can't recognize income on acquisition or disposal of any treasury stock. Net income or retained earning will never be increased through treasury stock transaction. So it says Murphy comprehensive income for the current year is correctly stated wrong. Since net income is wrong, your comprehensive income is wrong. Murphy net income from the current year is overstated. Yes, this 50,000 is the gain, not you report as a part of income statement. So you should have debited cash, credited treasury stock, and credited the additional paid-in capital. It doesn't go to income statement. So Murphy net income for the current year is overstated. This is not income to be reported on the income statement. B is the right answer. Which of the following is a false statement regarding the cost method versus the legal, or what you call the par or stated method, when accounting for treasury stock transaction? The timing of gains or losses recognized in transactions will be different under each method. This is the correct statement. This is right, because the primary difference between the cost method and the par method is the timing of the recognition of gains or losses on such transaction, treasury stock transaction. Gains or losses from treasury stock transaction affect retained earnings under the legal method. This is incorrect. This is wrong, because any loss goes to additional paid-in capital. You debit the additional paid-in capital when the treasury stock is repurchased at higher than the issue cost. However, when the additional paid-in capital doesn't have enough balance, only then we reduce the retained earning, or we debit it to retained earning. Otherwise, all transactions of gains report this to additional paid-in capital by crediting it. This is a false statement. Treasury shares are recorded at their reacquisition price under the cost method. This is absolutely right. No denying the fact. True. The gain or loss from treasury stock transaction is direct adjustment to shareholders' equity under the cost method. This is again a correct statement. It is 2 years ago, Carlyle Industries commenced its business by issuing 250,000 shares of 5 par for 28 per share. That was the original issue price. During the fourth quarter of the current year, the company repurchased 75,000 shares at 32 per share. That is more than what you received. Assuming that the par value or the legal method is used and there have been no stock repurchased to date, what accounts and amounts are debited for this buyback transaction? So under the legal method, you're going to debit treasury stock, common stock, with the par 5 times 75,000, that is 375,000 debit to common stock. You debit 28 less 5, 23 times 75,000, that goes to additional paid-in capital that is 1.725 million. The difference between original issue price and the price at which you're buying back, $4, that goes to retained earnings. 4 times 75, that is $300,000. And you credit cash, the amount you paid, that is 32 times 75,000, that is 2.4 million. So if you match these options, what you get, treasury stock, debit, additional paid in capital, debit, retained earning, debit, and credit is to cash. That is the right option, A. Company X had the following recent common stock transactions pertaining to the same stock issuance. In June of the prior year, issued 500,000 new shares of $2 per value common stock at 18 per share. That's the par. 18 is the issue price, that is $16 is the additional paid in capital. On January 1st, repurchased 300,000 shares of common stock at 20 per share. That is clearly more than the issue price. And on December 31st, reissued 150,000 shares of common stock at 21 per share. If the company uses the par value or the legal method, what is the balance of the additional paid in capital common stock account at December 31st year end? Assume the retained earnings account is not used. Let's see. This is it. 300,000 shares acquired by the company, and we paid $20 per share. That means 300,000 times 20, 6 million is credited. Now, what is the par of these shares? 2. 300,000 times 2, 600,000 debit to treasury stock par, and the differential clearly, that is 20 less to $18 times 300,000, that is the additional paid in capital. Then on December 31st, we reissued 150,000 shares of common stock at 21 per share. Let me show you the entry. So we are receiving 21 times 150,000 shares, that is debit 3.15 million for cash. Credit we give to par, that is $2. 2 times 150, credit common stock par, that is treasury stock, and the difference goes to additional paid in capital. The question says, what was the balance of additional paid in capital at the end of the year, assuming retained earning was not used? You can see par is $2, issued price is 18, so $16 represents your additional paid in capital. For 500,000 shares, you have an additional contributed capital of $8 million, clearly credit. Then this is the debit, 5.4 million, clearly it will be reduction, negative, and then again credit with 2.85 million. So what you get as the end, 8 million less 5.4 million plus 2.85 million, it's 5.45 million, and that perfectly matches with your option C. ASP company was organized on January 2, year 1 with 30,000 authorized shares of 10 par common stock. During year 1, the corporation had the following capital transactions. January 5th, issued 20,000 shares at 15 per share. Let's see. ASP used the US GAAP par value method to record the purchase and reissue of the treasury shares in its December 31st year 1 balance sheet. What amount should ASP report as additional paid in capital? On January 15th, issued 20,000 shares, $10 par at 15. Clearly, we receive more cash. 15 times 20,000, that's what you receive. $10 represents par. 10 times 20,000 common stock credited, and $5 represents additional paid in capital. 5 times 20,000, that is $100,000. So this is the entry on Jan 5th on the date of issuance. On July 14th, purchased 5,000 shares at 17 per share. July 14th, purchased of treasury stock 5,000 at 17 each. So 17 times 5,000, that's what you paid. Clearly, that is the cash. Since the company is using par value, so that means it's going to be, you're going to debit 5,000 times the par, treasury stock. You're going to debit the original additional paid in capital of $5 each. $5 times 5,000, 25,000. The balance goes to retained earning, and the total payment 85,000 is credited. Then on December 27th, reissued 5,000 shares held in treasury at 20 per share. So 20 per share times 5,000. That's what you receive, $100,000. What is the par? Par is 10. 10 times 5,000. You credit treasury stock with 50,000, and the difference goes to additional paid in capital. So very straightforward approach under the par value. It says Lem company, which accounts for treasury stock under the par value method, acquired 100 shares of its 6 par value common stock for 10 per share. The shares had originally been issued at 7 per share. By what amount would Lem additional paid in capital from common stock decrease as a result of the acquisition? First, let's make the entry when these shares were issued. When these 100 shares were issued, we would have debited cash at 7 per share, 100 shares 700, we would have credited the additional paid in capital by 1 times 100, that is 100, and credited the common stock with 600. When we are buying these shares back for 10 per share, that means clearly first we are paying cash, cash is credited. Debit treasury stock at par, 100 shares times 6, debit 600. Okay, now you need to reverse this additional paid in capital 100, and the difference of 300 goes to retained earnings. So the question says, by what amount would LEM's additional paid in capital from common stock decrease as a result of this acquisition? It decreases by 100. That makes B to be the correct option.